Here's an interesting numismatic curiosity. Some of you may have seen this disc, but I bet many of you have not. It has an interesting origin that relates to oil. Back in the early 20th century, Aramco was a group of 4 American oil companies that together had developed the oil fields of Saudi Arabia. They paid the Saudis $3 million each year in royalties in return for the rights to harvest the oil. This arrangement worked out well because the dollar was pegged to gold, which is what the Saudis ultimately wanted. During the Second World War, the price of gold bullion on the market exceeded the official U.S. government gold price of $35 an ounce by a wide margin. In 1945, the Saudis demanded to be paid in real physical gold instead of paper dollars. To assist Aramco in making the payments, the Philadelphia Mint struck 91,120 of these gold discs. Aramco paid the Mint for the gold plus minting costs, and then used these discs to pay the Saudis. Some of these discs can still be found. NGC has graded 183 of them, 10 of which have been graded MS62, and 1 has been graded MS63. To me, this is one of the most interesting pieces of minted gold in history, because it has some profound implications. Firstly, it demonstrates the desire of the Middle East for real physical gold. Secondly, it makes one wonder, if the leaders of the Middle East were no longer able to use the dollars they obtain for their oil into real physical gold, would the flow of oil continue? Let's explore this further. Here's some information I pulled from OPEC's 2012 Annual Statistical Bulletin. On the top is a graph of oil production from the 12 OPEC members as well as from the rest of the world. Note the fairly steady rise in total production from 20 million barrels per day up to the current production rate of 70 million barrels per day, though production has been fairly flat since 2004. Of the 70 million barrels per day produced by the world, 30 million come from OPEC members. The bottom graph shows estimated reserves, or known oil in the ground that's available for extraction. According to OPEC, about 81% of the world's reserves are located in the 12 member countries. They estimate their reserves to be 1.2 trillion barrels. This number is a source of great controversy. Despite a production of 11 billion barrels per year, the reserve number hasn't been changed in many years. In addition, it has never been audited. But let's assume that the number is accurate. 1.2 trillion barrels at 11 billion barrels per day per year use is about 100 years worth of supply, right? Wrong. As oil fields age, the wellhead pressure declines and it becomes much more difficult to extract the oil. For example, Saudi Arabia has been flooding the Ghawar field for years with seawater to maintain the wellhead pressure, and each year the water cut grows larger and larger, indicating that the field is in decline. The Ghawar field is the largest oil field in the world, and it serves as a reminder that oil is a finite resource. OPEC is well aware of the finite nature of their reserves. This is one reason why they covet physical gold as opposed to paper dollars. In the long run, as their oil wealth depletes, they want to have some wealth stored in a form that's going to endure. After all, how valuable will be the promises of an industrial powerhouse once the fuel that enables its industrial might becomes less abundant? Here's an interesting visual display I pulled from the BP Statistical Review. It shows oil consumption by geographic area. By far, the largest consumer of oil is the United States, coming in at 18.7 million barrels per day. This is huge! With a population of about 300 million people, this is about 23 barrels of oil consumed each year for every man, woman, and child living in the States. Referring back to my earlier videos, I mentioned that historically 1 ounce of gold has purchased between 10 and 25 barrels of oil. If the US is consuming 23 barrels of oil per year per person, this is like saying it is costing us between 1 and 2 ounces of gold per year per person to maintain our current standard of living. This is absolutely huge when you consider that only 100 years ago it was not uncommon for a person to be paid about 1 ounce of silver for a week for their labor. We truly are dependent upon oil for our current standard of living, and I think we do take it a little bit for granted. Other nations consume a fair amount of oil as well. For example, China consumes about 8.6 million barrels of oil per day. The rest of their energy needs are met by burning coal. This is a very large amount of oil, but per person it only amounts to about 2.5 barrels of oil per person per year, about a tenth of what is consumed per capita in the US, and a good deal of that energy is consumed in making non-durable goods to be sold to the US. So let's visualize the flow of oil and the flow of dollars. The US has about 31 billion barrels of oil reserves, and it produces about 1.8 billion barrels per year domestically. It consumes 6.7 billion barrels per year, so 4.9 billion barrels need to be imported to meet our consumption needs. At roughly $100 per barrel, this means that we export about $490 billion for the purchase of oil alone. Of that 4.9 billion barrels, 2.2 billion come from OPEC, and 2.7 come from other nations of the world outside of OPEC. In addition to the 2.2 billion barrels produced each year and sent to the US, OPEC produces 4.9 billion barrels per year to sell to other non-OPEC nations, and 3.9 billion barrels per year to be consumed by the OPEC nations themselves. For all of their exports, OPEC will receive about 710 billion paper dollars per year, or their electronic equivalent. What do they do with all these paper dollars? Some of them will be spent domestically, but what if they want to preserve some wealth for the future? This presents a problem. If anywhere near this amount of paper wealth were to bid for physical gold, it would send the price sky high. As the price of gold increased, it would capture the attention of Western speculators, who generally will only buy things they see are going up in price. The increased attention would make physical gold even more difficult to obtain because there would be more competition for it. There has to be another way for OPEC to obtain the physical gold they want. Now here's where the story gets a little bit more speculative, but I think it's a theory that makes sense. Enter the gold loan. Gold loans are a fairly complex topic. I can't do the subject justice in only a few moments, but since it's necessary for this presentation to understand what a gold loan is, here's a quick summary. Let's say you're a gold mining company, and you want to bring a project online. You're fairly confident in how much gold you've discovered underground, but it will take a long time to start producing it, and a large capital investment will need to be made. In short, you need cash flow, and you need it now. You approach a bullion bank for a loan. You're probably familiar with bullion banks, and have heard them vilified over and over again. These banks are Barclays, Scotia Macata, Deutsche Bank, HSBC, JP Morgan, and UBS. The bullion bank acts as an intermediary for a special contract, the gold loan. The bullion bank borrows gold from a central bank and sells it in return for dollars, which it then loans to you, the miner, to fund your project. You, in turn, agree to pay the loan back from the gold you mine once your project starts producing. There are a lot of complex nuances to how these deals work, including hedging of the gold price via the futures market, but this is the essential gist of it. That the bullion bank borrows gold to generate cash to fund a mining operation, which then pays the gold back at a future date. Does the gold need to be physical and come from a central bank? No, not really. A bullion bank can make an agreement with any entity, such as an OPEC nation, to exchange current dollars in return for future gold. So if an OPEC nation was interested in securing real physical gold in exchange for their surplus cash flow, while hiding their purchases from a tight market, they can go to a bullion bank and work out the deal. The miner gets his immediate cash flow, the bullion bank makes a nice profit off of the deal, and the OPEC nation secures a future stream of real physical gold. Everyone's happy. So we see in this picture that gold mines of the world have a proven reserve of 1.6 billion ounces of gold, and they produce 0.08 billion ounces per year. If we make the link between the world mining operations and OPEC's excess cash flow from oil production, we can see that OPEC can spend up to $700 billion per year to secure up to 0.08 billion ounces per year in real physical gold. This isn't to say that OPEC invests $700 billion per year for this purpose, nor that they take the full 0.08 billion ounces in real gold production, but that some relative fraction is probably taking place. I propose, and I'm not the first to do so, that it is this flow of real gold from a future production that is securing our current flow of oil. So what if the market breaks and gold no longer flows? What will it do to the flow of oil if OPEC is not interested in dollars? Something to think about. Please feel free to comment.